If you're contributing to a 401k plan, that's amazing. But here's the truth. Contributing is step one. How you invest that money is actually what grows it. And this is where most people freeze. Today I'm going to break down the main investment categories inside a 401k, what risk really means, what index funds are and stable asset funds, and how to think about choosing what may make sense for you. So let's simplify this. Think of your 401k like a grocery store. Contributing is walking into the store. Investing is choosing what goes into your cart. If you don't choose wisely, the money may not grow the way you expected. Inside most 401k plans, every investment usually falls into one of 5 main categories. So let's go through them. Number 1, stock funds or equity funds. Stock funds invest in company shares. So you might see large cap funds, and these invest in large, established, and well-known U.S. companies. Mid-cap funds invest in medium-sized firms, offering a balance between growth potential and stability. Small-cap funds. These invest in smaller companies with high growth potential but higher volatility. And international funds. These invest in companies outside the U.S. Now, stock funds generally offer higher growth potential but also higher volatility. This means your balance will go up and down. And historically, stocks have grown more over long periods, but they can be bumpy in the short term. If you're younger and have decades until retirement, stock funds often make up a large portion of a portfolio. Next is bond funds. Bond funds invest in loans made to governments or corporations. They generally fluctuate less than stocks, provide more stability, though their value can decrease when interest rates rise, and offer long-term growth. Bonds can help smooth out market swings, and they're often used more heavily as someone gets closer to retirement. Number 3, index funds. An index fund simply tracks a market index, like the S&P 500. Instead of trying to beat the market, it matches it. So why do people love index funds? Broad diversification, lower fees, simple strategy, and historically strong long-term results. Now here's an important note. Index funds are not automatically low risk. A stock index fund still moves up and down like the stock market. A bond index fund moves like bonds. They just follow the market instead of trying to outsmart it. Number 4, target date funds are all-in-one funds. You choose the year closest to when you plan to retire. For example, target retirement 2055. And these are typically set it and forget it options that automatically adjust the mix of stocks and bonds to become more conservative as you approach a specific retirement year. When you're younger, it holds more stocks. As you approach retirement, it automatically shifts more towards bonds. It adjusts risk for you over time. These are great for people who don't want to manage allocations themselves. Number 5, stable value or stable asset funds. Stable value funds focus on preserving your money. They have very low volatility, pay modest interest, and rarely fluctuate. They are considered very low risk. But here's the key. Low risk usually means low growth. If someone is 30 years old and keeps 100% of their 401k in a stable value fund, they may significantly limit their long-term growth. So stable value funds make more sense if you're near retirement, for conservative investors, or a small portion of a diversified portfolio. So what risk really means? Risk just isn't about numbers. There are 3 types to think about. Number 1, market risk. Your balance goes up and down. Number 2, time risk. How long do you have to recover from downturns? And number 3, emotional risk. Can you stay invested during a 20% drop in your account? Your real risk tolerance shows up when markets fall, not when they rise. So let's look at this comparison chart so we can see all of the different categories at a glance. Stock funds. They have high growth potential, they have high volatility, and they're best for a long-term horizon. Bond funds. They have moderate growth potential, moderate volatility, and they're best for balance and stability. Index funds. This varies from moderate to high. Volatility. This varies. It's less volatile than stocks, and it's best for low-cost diversification. Target date. The growth potential is that it adjusts over time. The volatility also adjusts, and this is best for hands-off investors. Stable value. The growth potential is low. The volatility is very low, and this is best for capital preservation. Now let's talk about expense ratios. Let's talk about something people overlook, fees. Every fund has an expense ratio. That's the percentage charged annually to manage the fund. For example, an actively managed fund might be 0.75%. An index fund might be 0.05%. That may not sound like much, but over 20 or 30 years, that difference can mean thousands, even tens of thousands of dollars. Lower fees means more of your money stays invested and compounding. And this is one reason why index funds are so popular. Now let's look at some common investing mistakes inside a 401k. Leaving everything in stable value for decades, picking funds randomly, ignoring fees, never rebalancing, or trying to time the market. Understanding categories makes everything less intimidating. Every fund in your 401k fits into a bucket. Once you understand the buckets, stock, bond, index, target date, or stable value, for example, you're no longer guessing. You're choosing, and that's powerful. And as always, this is for educational purposes only. Your situation may be different, so consider speaking with a financial advisor before making any changes to your investment selections. If this video helped you, please like and subscribe for more practical retirement and 401k education. See you in the next video.